first, this sounds wrong. In the world of money, the people who borrow the most are often rewarded. And the people who save the most quietly lose. That's not a conspiracy. That's the system doing exactly what it was designed to do. If you've ever wondered why governments drown in debt and keep going, why massive companies borrow billions even when they're profitable, or why your savings feel like they're running on a treadmill, this is why. And once you see it, you can't unsee it. Right now, across the global economy, debt isn't treated like a weakness. It's treated like fuel. And the system bends around it. Let's start with something simple. Imagine two people. One saves cash, carefully, patiently, for years. The other borrows aggressively, buys assets, expands, takes risk. Intuitively, you'd expect the saver to be safer. But over time, the borrower often ends up richer. Not because they're smarter, but because the rules quietly tilt in their direction. This matters right now because debt levels are exploding everywhere. Governments, corporations, households. And instead of slamming the brakes, the system keeps finding ways to make borrowing easier. So how did we get here? To understand this, you have to forget moral ideas about debt. Forget debt is bad or debt is irresponsible. Those ideas don't run financial systems. Math does. Start with how money is created. Most people assume money is printed by governments. In reality, most money is created when someone borrows. A bank doesn't lend out existing money. It creates new money the moment it issues a loan. A mortgage, a business loan, a government bond purchase. New money enters the system as debt. That means the system grows when borrowing grows. No borrowing, no expansion. This is the first quiet advantage borrowers have. They're not just participants. They're the entry point. Now layer interest on top. Interest sounds like a punishment for borrowing. But zoom out. When the economy grows faster than the interest rate, debt shrinks in real terms. If inflation runs at 4% and your loan costs 3%, the system is slowly erasing your debt for you. Your future income is worth less. Your fixed debt stays the same. Time works for the borrower. Time works against the saver. That's the second advantage. Savings sit still. Debt melts. Now scale this logic up. Governments understand this better than anyone. They borrow massive amounts not because they're reckless, but because inflation, growth, and currency control make repayment less painful over time. A government that controls its currency can stretch debt across decades. They don't need to pay it back the way a household does. They just need to keep the system functioning. As long as the economy grows and trust holds, debt rolls forward. That's why debt ceilings feel dramatic but rarely change outcomes. The system isn't designed to eliminate debt. It's designed to manage it indefinitely. Corporations learned this lesson too. A company with stable cash flow doesn't rush to pay off cheap debt. It uses it. Borrow at low rates. Buy assets. Buy competitors. Buy back stock. Debt boosts returns when things go well. And if things go badly, the downside is often capped. Restructuring, bailouts, bankruptcy protections. This is where the system's preference becomes uncomfortable. Losses are socialized. Gains are privatized. Borrowers get leverage on the upside. Limited damage on the downside. Savers get neither. Now let's talk about inflation. Inflation is usually described as a problem. Rising prices, shrinking purchasing power. But inflation is incredibly useful to borrowers. It silently transfers wealth from savers to debtors. Every year prices rise, the real value of debt falls. Your loan doesn't change. The money you repay it with becomes cheaper. This isn't accidental. Moderate inflation is considered healthy precisely because it eases debt burdens across the system. Central banks target inflation not just to stabilize prices, but to stabilize debt. Too little inflation and debt becomes heavier. Too much and trust breaks. So the system walks a narrow path. And savers are standing right in the middle of it. Here's the irony. People who avoid debt often believe they're being conservative. But in a debt-based system, avoiding debt can be the riskier choice. Because the system doesn't reward stillness. It rewards movement. Assets inflate. Wages lag. Cash erodes. Borrowers are pushed forward by the current. Savers swim upstream. Now zoom out again. Why does the system tolerate this imbalance? Because the alternative is worse. If borrowing collapses, money supply contracts. Businesses cut spending. Jobs disappear. Debt defaults cascade. This isn't theoretical. Every major financial crisis begins with borrowing slowing down. 2008 wasn't caused by too much debt. It was caused by debt stopping. That's why central banks panic when credit freezes. They slash rates, inject liquidity, encourage borrowing again. Not because borrowing is virtuous, but because the system collapses without it. So borrowers aren't just favored. They're necessary. That necessity quietly reshapes policy. Tax codes favor debt over equity. Interest is deductible. Asset gains are lightly taxed. Risk-taking is encouraged. Caution is penalized. And the longer this runs, the more fragile it becomes. Because debt works beautifully until it doesn't. High leverage amplifies growth. It also amplifies shocks. Small mistakes turn into systemic crises. And when the system shakes, the response is almost always the same. More borrowing, lower rates, bigger balance sheets, more liquidity. The cure deepens the dependency. This is the uncomfortable math at the center of modern finance. We've built an economy that can't easily function without expanding debt. Borrowers are favored because the system itself is a borrower. Now here's the part people don't like hearing. This doesn't mean borrowing is always good. It means the system nudges behavior in a specific direction. Those who understand the rules can use debt strategically. Those who don't often use it destructively. The system doesn't care which one you are. It rewards leverage, then deals with the consequences later. And the consequences are growing. Rising inequality, asset bubbles, political tension. When asset owners benefit from inflation and leverage while wages lag, trust erodes. And trust is the real foundation of financial systems. Not money, not debt. Belief. Belief that tomorrow will be better than today. Belief that obligations will be honored. Belief that the system is worth participating in. Once that belief cracks, no amount of borrowing fixes it. So here's the question to sit with. If financial systems are built to favor borrowers, what happens when everyone is already maxed out? When debt stops being fuel and starts being friction? And if saving quietly loses value while borrowing shapes the future? What does that mean for how we think about responsibility, risk, and fairness in the economy ahead? Because the system isn't neutral. It never was. And the direction it favors tells you exactly where the pressure will break next.